Money Show.
Personal Finance with Warren Ingram.
Warren Ingram is the director at Galileo Capital. He is a personal financial advisor. They even made him Financial Advisor of the Year once, a long time ago. Warren, welcome to the Money Show this evening. The Chinese government
What an intro, thank you.
Thank you. Anytime. It's not the one I was working on, actually. I had a much nastier one. The Chinese government is rattling cages in China, clamping down on their own companies. But so much of the world's investment has gone into China in the last 20 years, and we've become very used to the returns out of China over the last 20 years, most particularly as South Africans, in Naspers and Prosus, courtesy of Tencent. And that has been challenged and threatened and possibly undermined. I'm not too sure if it's permanent, but certainly it's been tough in the last couple of weeks.
It has been, Bruce, and if you look at the wording coming out of China from their government and their regulators, it's not comforting that this is a short-term thing. It seems to be kind of like a renewal of a 5-year plan. Their 5-year plan ended in 2020. There hasn't been much news from them for quite some time, and almost out of the blue, we start to see a raft of regulations affecting quite a lot of the very big tech companies in China, but more and more one realizes it's not just the tech companies, it's actually going to impact most levels of Chinese society, and it's posing huge uncertainty to both I guess the Chinese economy and also people wanting to invest in China, and then therefore our little country getting massively affected simply because of our exposure to Tencent. And it does raise the kind of the scary prospect that the big engine for emerging market growth for the last 2 decades might be coming to an end. And if it's not coming to an end, it's certainly going to be a massive unsettling time. And the Chinese government has been very clear that they are targeting monopolies, and so the ability for the next Tencent or the next Alibaba to grow out of that market is going to be very difficult. They really want lots and lots of small versions of Tencent and Alibaba's going forward.
And that's their prerogative, I suppose. Our prerogative is whether or not we stay invested in China. What do we do?
Well, I think it's an interesting time to be an investor because we've got 2 major trends which I think are coming to maturity, let's say. I think it would be arrogant to call them coming to an end, or for me to call them at an end. And the first is the big tech story in the States. So the big technology companies that have just been absolutely dominant and growing, year after year, making huge profits, and generating enormous amounts of cash, both in America and around the world, and doing so almost unfettered by regulation. And definitely that story is changing. It started in Europe with the European regulators going after, mainly these big American companies. And now, of course, in China with the regulators, they're affecting their economy. And it raises the prospect for lots of investors to reconsider their view of just following major trends. And that's really my theme is, I think be careful when we see a major trend happening in the investment world. We jump on this bandwagon. They've even given it a name. It's called momentum investing. And it's a very comforting thing to be in because, you see this momentum start building up. You see more and more positive articles online. We hear more and more people talking about it. The talking heads like me start getting excited about the next thing that's going to change the way the world gets done. Whatever it is, whether it's the way we fly, whether it's the way we drive, store energy, whatever it is. And we get caught up in this theme. And very often, those big trends can be very profitable for investors. But I think we need to exercise caution. And firstly, understand that a new technology doesn't translate to a new investment trend. So for example, if we go back, my favorite example of this is the way that the internet kind of exploded in the late 90s. It was something that wasn't in our lives, and almost over a 2-3 year period, it suddenly was there. And people with vision were looking at this and saying, we think that the way business gets done can be changed completely by the advent of the internet. And they were absolutely right. where they were horribly wrong was they were too aggressive by about 10 years. It really took about 10 years from the late 90s for the internet to really change the way we do business. So be careful when you're making these big kind of investment decisions based on trends that you don't get caught out. And when they change, when they stop those trends, that they basically hit a wall and they crash. And I think we might be seeing that, at the moment. And if you're going to do this, you need to be looking forward for the next 20 years and wondering what are the big demographic changes that are going to happen. So, for example, people are getting older around the world, especially in the Western world and, places like Japan. And what does that mean for investing? Because, demographics is a hugely reliable way to form trends. And in a continent like ours with a very youthful population, what does that mean? What will our continent and what will our country be looking for, and especially the youth, and how can we benefit from that? But just based on a new form of technology, I think that's a dangerous trend to follow. So, my comment would be, what do we do now? Well, go back to basics. If you believe you can understand what the next big trends are going to be, that may be very profitable, and certainly allocate some money to those. But at the same time, make sure you've got a major spread of your investments when the world goes into periods of increased uncertainty. I think we have to realize uncertainty is a part and parcel of life for all of us now. But when it goes on almost on steroids like it is now, then your only antidote to that kind of uncertainty and that kind of what the commentators would say volatility is to be really spread with asset classes. It's to be really spread across all parts of the world, and don't make huge bets in one direction only. Make sure that if you believe the world's going to go in a certain direction, have some money invested if that doesn't work out, so that you can still offset your potential losses. So I think, yes, trends are great and they do work, and certainly, I wish we'd all been able to forecast that the way that China would have taken over, but we can't. But then make sure you've got the diversification to protect you if it goes wrong.
Fabulous. Thank you, Warren Ingram. That gives us a nice insight into how to deal with the China crisis. Email that came through for us this week, and it comes from Giselle. Giselle says, I'm not sure if you can assist, but my gardener has asked for help and information on how he can invest R1,000 by buying shares and using online investment tools. I mentioned the benefits of seeking help from banks. There's red rag to Warren's bull. He's still very keen to find out more about the subject and experimenting with the market himself. I have researched a little and given him some links to key SA sites that might be a good place to start, but I'm completely out of my depth in offering him any advice, which is nice and honest. And I've got no background in finance and also need to learn the basics myself. Perhaps you can go on this journey together, Giselle. My gardener only has basic schooling. He's smart, though. He's got drive and curiosity. If you've got information, ideas that I could pass on, I would be very grateful. Well, I think for the next 5 minutes, Giselle, what you're going to do is you're going to pay very close attention with your gardener and anybody else, frankly, in your life who wants to get started, because that's what podcasts are for. And you can share them and listen to them 20 times if necessary. But Warren's going to bring you some insights, I hope, fingers crossed, on how to get started. 101 in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Giselle looking for help to assist somebody who works for her to embark on an investment journey. Giselle is feeling a little out of her depth, however. Warren Ingram, I don't care who the person is that you're trying to help, especially when you don't know yourself. And you could use this as the world's best learning opportunity. So put us on track, if you would.
Love the question, and I agree with you, Bruce. It's something that if Giselle doesn't feel comfortable teaching someone, it's a great time to teach herself while she learns alongside her employee. And I think the starting point is. You touched on it at the intro about online resources and especially the media. I mean, I think we spend hundreds of hours every year talking about this on the show, and as you said, the show is podcast. So first thing, Giselle, is give your employee access to your Wi-Fi and make sure that you set aside some time for him to listen to the podcast. If you can't listen to it at home. And start there, because I think the education part of this is huge. And there are a lot of resources that are available online for free. So, you mentioned the banks, and I think that one of the things about the banks now is they're getting better at providing free educational material on their websites, which I think is hugely helpful. And then the kind of new entrants to the investment world, companies like Easy Equities and Satrix and 10x are all offering really good information and really good education on investing on their websites, and it's all absolutely free. And I think that would be my starting point, is before he commits any money to investing, is spend some time understanding what's going on and how investments work, and especially if it's going to be shares, understanding that shares are great and certainly my favorite asset type to grow your money over a long period of time. But unfortunately, they're not perfect. They come with enormous roller coaster rides of great returns followed by awful returns and everything in between, and can often be really scary to be an investor. And so having said that, you shouldn't be deciding to take your lump sum and just buy one or two shares. I really think he should be looking at an index and something really generic, kind of taking half the money and buying the top 40 or top 50 shares in South Africa, and the other half of the money and buy the world index. All of those are shares, and they're they give great exposure to lots and lots of companies in South Africa and all around the world, and gives them great growth, hopefully, but certainly will give a lot of protection against the collapse of one business or one sector of the economy or the stock market falling apart. So very quickly, that would be my suggestion, Giselle. But to have the kind of the personal finance segment on your podcast as a favorite and get him to listen to that every week and do it together, I think is a great idea. And then go and look at the websites of those companies I've mentioned, because they offer some fantastic information.
But that idea of going into the index, and then once you've put your money into the index, and then looking what's in the index and seeing what's going up and what's going down, and how this incredible volume of information that goes through a stock market on a daily basis translate to half a percentage point gain or a percentage point decline, or whatever the case might be, it is the most incredible nursery for anybody who's wanting to start out on an investment journey, provided they're open to learn. Because you can go invest in those index funds, ETFs, completely blind. You don't have to care about what's in there. But if you've got a desire to learn, I can't think of a safer way to do it.
No, I agree. I think, and I think my one message would be, all of these exchange traded funds or these indices, they have very good, information about what goes into those investments, and so you can actually go and see what those companies are that you own. You'll own, a fraction of a share of Apple Computers, and you'll own, Johnson & Johnson Pharmaceuticals, and so as you start to understand that actually that top 40 or top 50 index in South Africa and the world index is not just a name of a thing. It's actually, lots of shares in lots of different companies. And once you understand who the companies are that you now own, you start to become interested in them, and you start to follow the news stories that are being written about them. And, the information online is incredible, So as you start to build up your knowledge base, you can become braver and maybe more confident to make some more concentrated investment decisions. But the one thing I always want to say, just a new investor, a novice investor, is you have to be prepared to lose money. I think you need to say, if you're starting with 1,000 Rand, the only promise I'll make you is that at some point your 1,000 Rand will be worth 500 Rand. But over a 10-year period, your 1,000 Rand will be worth a lot more money. But you need to be prepared for the halving of the money first, because that is what's going to happen, unfortunately. And that's part of the price of being an investor. And if you can make that deal with yourself, then by all means, I think it's a great journey to go on and a great way to educate yourself and get to financial freedom.
And just have a look online, Giselle, for the Julia podcasts and the Julia stories that are on facebook.com/Bruce Whitfield. Bruce Business, I beg your pardon, /Bruce Business. Facebook.com/Bruce Business. There's a whole heap of stuff there. On to the final thing. I would like to know from you, Warren, what is contrarian investing?
So contrarian investing is is, well, firstly, a contrarian investor is somebody who has a very high tolerance for pain and can deal with an enormous amount of suffering with the hope of making some money at the end. Because a contrarian investor is somebody that says, if the whole world, investment world, believes one thing is going to happen, for example, that technology is the way to go, and we should just be buying, Microsoft and Apple and Facebook and Amazon, etc. The contrarian investor goes, what happens if I do the opposite of that? What happens? What are the opportunities for me to buy the things that are the very opposite? And I would guess in a time like now, they would be looking, for example, at the fossil fuel companies, companies that are still mining and drilling oil and looking for, the opportunities there and saying to themselves, those might be companies that still deliver good returns for investors because their share prices have been to some extent decimated and the world is definitely not in love with fossil fuels anymore and are considered old technology. And so a contrarian would look at that and say, well, maybe there is still the opportunity for me to make money. And in days gone by, whatever the other big trends were, that they would, for example, when house prices were booming in America, a contrarian investor would say, this party is going to end. What can I do if that is going to end? What are the things that are going to make money? How can I make money out of a collapse in the house price market in America? And so, they'll always be doing the opposite. That doesn't mean, though, that once they've looked at what the world's doing and what the big trends are, they don't simply invest in the opposite of that, out of pure principle, that they're still going to go and try and identify companies that are trading at very low prices relative to the value that those companies actually have, and then say, well, if there's a discount in the price compared to the value of that company, I'm going to invest in that, and then I'm going to wait. And I might need to wait for 1, 3, 5, 10 years, who knows? But at some point, that kind of big trend that's been going in the one direction is going to fall over, and then my contrarian investments are going to do well. So it's what Warren Buffett talks about when he says, run into the burning building when everyone is running out. It's painful in the short term, but it might be very lucrative in the long term.
Warren Ingram, Galileo Capital, personal financial advisor and regular contributor here on The Money Show on a Thursday night. Thank you, Warren. Asked and answered. You can send us your questions, of course, via any platform you choose, and we'll do our very best to get Warren to answer them for you.